Hey everybody, and welcome to Wall Street Wildlife. A couple of weeks ago, Christoph and I had the pleasure of being guests on the Dividend Talk podcast. Now, if you're a regular Wall Street Wildlife listener, you'll know we're all about growth and the discipline of being a long-term investor. But on this interview episode with our friends at Dividend Talk, we went deep on a topic that might be a bit new to many. Really, the practicalities of retiring early on a portfolio built entirely on growth stocks. We covered the criteria we both use to pick companies, how we actually manage the finances of living off of a growth portfolio. We also got some fantastic listener questions. Our friends at Dividend Talk hosted a brilliant discussion, but we thought it was too valuable not to share with you guys on our own feed. So without further ado, here's our guest appearance on Dividend Talk.
Welcome to Dividend Talk, episode 256, an interview about how to retire on a pure growth strategy with the co-host from Wall Street Wildlife. Welcome back everyone. Today is going to be a really interesting podcast episode because this is the first time that we're interviewing someone who has retired on a pure growth strategy. Today we have Monkey and Badger from the Wall Street Wildlife podcast. Definitely check them out. Links are in the description. And yeah, it's a topic that is actually quite unknown to us, to Derek and me. So we were very curious how to do this. We truly believe that there are multiple ways that lead to Rome. So it was about time that we spoke with someone from the other side about this. But we discussed with Monkey and Badger what kind of criteria they apply when they're selecting growth stocks, but how it in practice also looks like living off, let's say, a portfolio based on growth stocks. But hey, besides that, many of the listeners' questions also are answered again. And yeah, if you're not yet a Dividend Talk Premium subscriber, please do check it out. We have nearly 40 deep dives there, mostly about European dividend growers, and more than 100 dividend stock cards, both from the US and the European Union. Hey guys, let's get started.
Hey European DJ, how are you feeling, buddy?
I'm feeling okay. I know why you're asking.
Oh yes.
Maybe also later for our guest, I had what they call in Polish an ognisko. So with some friends, and there was some vodka involved, there was some beer involved, there was some tequila involved. But I made it home and I slept a few hours, and I don't feel like a huge hangover, so I'm still good.
Yeah,
so.
yeah. Well, our listeners are used to me being on this show, maybe sounding a little bit groggy and a little bit hungover. So it's a nice change to have you reverse the roles this time.
Yeah, but we need to do a vodcast again one time. Next time we meet, we'll take a bottle and we re-record again.
Yeah, that was fun. That was fun. But today we have a really cool show. We have the guys from Wall Street Wildlife podcast on. And if you haven't listened to that, I suggest do it. It's really entertaining. But Christoph and Luke, welcome to Dividend Talk.
Derek and European DGI, thanks for having us on the show. Great to catch up with you.
Oh, it's great. It's great to have you. So just for our listeners, and you can go one at a time, but maybe you can introduce yourselves, how you met, how the podcast started, and so on. Just give us a brief overview, if you don't mind.
Sure. Luke and I met while we were lead analysts over at 7 Investing. And then we would give our monthly sales pitches, and right out of the gate, Luke stole one of my main best ideas because he had seniority over me, and that was NVIDIA. And then that went on to compound by hundreds of %. So ever since, I've been plotting vengeance. So our own podcast is like a really sinister way of me sort of getting the inside scoop on all of his activities.
Christoph says that's how we met, but actually he and I, or at least my eyeballs go way back with him. So he used to write for the Motley Fool decades ago, and I've been interested in this weird world of investing for as long as I can remember, but at least the last 25 years. And way back at the start, when I found like the David Gardner's book and got into that world and started reading the Motley Fool. There was this weird guy on their message boards called CMF Monkey, who used to talk about really weird, complex investing topics through the lens of being like a monkey in the jungle and throwing bananas around. And Christoph, it turned out, was him, and he was one of the writers that made me understand these are not just stocks; these are actual businesses doing real things.
Awesome, awesome. So why did you come together to start a podcast then? What's the aim of this podcast that you have?
So Wall Street Wildlife, Christoph and I have an episode out every week. We're on YouTube, we're on all the major podcast platforms. He and I, we're very experienced investors. We've had more complex podcasts in the past. This one is aimed at beginners, intermediates, experts. We try and take investing, growth investing specifically, and we try and make it simpler, fun. I love your intro. This is like a pub chat, like relax. That's exactly the style we try and have on Wall Street Wildlife. We shoot the shit. So am I allowed to say that?
Yes, you can. It's pub talk.
It's like 7 a.m. I'm swearing already. We shoot the shit. We talk about like the ins and outs of companies. We challenge each other. Like we go for each other's throats on our own investment ideas sometimes, and our listeners seem to love that. So two different voices.
Nice. And is that easy to continue challenging each other? Because I think Derek and I have a little bit that over time, I mean, we're now at podcast number 256, that you start to follow similar patterns, like almost like a married couple, that you start to grow slightly towards each other. Maybe the fighting time will come at a certain moment, the bitching time, but we're not there yet, I think.
If I may, this is fascinating because my strategy was almost identical to Luke's current strategy. It's pick the world's best businesses and let them do their thing. But somewhere I took a wrong turn, cornfields of Nebraska. And at the moment, I'm mostly invested in very sort of high risk, unproven, pre-revenue, biotech stuff, like weirder stuff. And so in this particular moment, he and I have very contrary styles. But what's similar is that we preach the same 10 principles of investing that guide all our decisions. And this is the thing that I think we teach more than anything else, is that anybody really can invest with the proper fundamental perspective and not just behavioral psychology, but those principles based on the 40 years of cumulative experience that we have.
Oh, it's quite interesting. So what made you diverge then? Why did you change your strategy to like more high risk?
I really became deeply concerned for the first time in my investing career about the U.S. debt.
Okay.
Debt load. And I think it was two years ago, there was a lot of bad stuff happening, real estate prices and the debt and the inflation stuff not being able to, under control, and the market was highly valued. And I thought, wait a second, this just is not going to end well. And so I made a kind of half pivot into, there were a bunch of pre-revenue companies I was very excited about, did a lot of due diligence about them. I saw the future of AI and energy going in that direction. So I kind of doubled down into a very concentrated portfolio of future ideas away from the ones that had high multiples and were already highly valued.
Yeah.
So it's basically fear. I kind of bought into a lot of fear for the first time in my investing career. And I was wrong.
The market continued to rip as Christoph went like heavily to cash. And your own retirement plans got pushed back a little bit, buddy. Is that right?
That's correct. But now I'm back. I'm back on track.
Back on track. Well, look, we might talk about these 10 principles that you spoke of later on in the show, but we might take a step back first and tell us what your investing journey looked like. How did you get involved, and how did you pick growth investing and that kind of thing?
I started like in the late 90s, early 2000s, and it seems a bit dumb. Like I was sat idly at work one day drinking coffee and just kind of looking out the window. And I just read the E94 book, and I kind of got this idea of compound interest into my head. And I just built a spreadsheet, and I said, well, what if I start investing? And the UK has an incredible, even so it was nascent back then, but an incredible kind of tax efficient investing structure called the ISA, individual saving account.
Yep.
And I thought, well, what if I can manage to max out my ISA allowance for, for the rest of my life, and if I can get, I was woefully optimistic. I thought if I can get like a 16% compound annual growth, I thought, what does the numbers look like? And the numbers became like astronomical as I got, like 100 rows down the spreadsheet.
Yeah.
So I thought, well, screw it, let's do it. So let's go for it. And that kind of started the journey for me. And
Interesting. And Christoph?
And and for me, I also read the Motley Fool Investor's Guide when I was 17. And what got me there is I was always a literary guy. I have a PhD in English literature. But the Shakespeare angle, the way the Gardner brothers sold investing through stories and ideas about life through Shakespeare quotes, that really got me as a 17-year-old. But at that time, the internet was coming to life. And so I remember it was like some summers I was maybe working as a camp counselor, summer college or something like that. And I would see these gains of like 20%, 30% a day. There's some period, some biotech, I think it was Centero, and they were decoding the genome for the first time. And that particular company was on my radar. And it was just like the triple digit gains seemingly every day was like, I could not believe this. Like this was a real thing.
Yeah.
And of course, this was relative to being on the train going into New York City, reading old school newspapers, right, in my hand, where you would look at the stock charts and you would see -1/2, +3/4. And then all of a sudden, like on the screen, hundreds of percent flashing by. And I was like, what is going on? So I kind of became, I don't know if addicted is the right word, but it's like, I have to find out what is happening in this world right now. And then I just started learning consistently.
I sort of figured out quite early on, like being an investor in individual companies as opposed to like indexes and, in air quotes, boring stuff. It's an incredible way to understand the world and look at the world. And that's what really drew me to growth companies. Like the very first individual company I ever invested in was a firm called Intuitive Surgical. And I got in 2006. I probably put like, at the time, a crazy amount of money, a crazy allocation into that. And it's turned into now a 66 bagger for me. It was, until last week, it had always been the biggest allocation in my investment portfolio. So it's been exciting, like watching my money compound at this incredible rate that's way faster than I ever anticipated I could do when I built that spreadsheet back in the 2000s. But at the same time, I'm studying the company and watching it and seeing how it's evolving and becoming like dominant, leading the field of medical robotics. And what an incredible, like, it's almost like Star Trek, like incredible way of understanding the trajectory of technology and how we're evolving as a species, but studying it through the lens of companies doing real things and making the world a better place. And so that's really become like the ethos of my own investment portfolio.
So have you always been growth investors? Always? You started as a growth investor. And you've gone through then, say, the great financial crash. And did that change your perspective around investing in growth companies or anything like that?
It did not for me.
Okay.
It made me, God, I remember those days, the 2008 crash. So it's a while, it's what, 15 years, how long ago is it? Now, 17 years ago.
Yeah.
But I remember at some point studying Google, and of course, Google's price shared, and there they had this truly astounding business model. I was like, these guys are selling for less than cash somehow. And I was like, how is any of this possible? Is this crash not overdone? And I was like, this can't be overdone. I'm sorry, it is just panic. It's not like rational anymore. So the companies that need to die will die, and some of those banks went under. But then Google came, back, and that kind of actually solidified my thesis that if you invest in the company and not the price, then the fundamentals will win out.
And like the same, Christoph and I have both been doing this for well over 20 years each now. And yeah, like if you look at the stock, like the world is volatile, macro comes in, crazy things happen, tariffs on, tariffs off. Like there's always some reason to be afraid. But if you look at the execution of the company, which is what I've always been drawn to do because I'm just fascinated with the companies I'm invested in, well, you can see through a lot of that. And if you, like my own sort of investing framework, if I had to sum it up in like one sentence, it's owning the companies that I think the world will need more of in 10 years' time.
Yeah.
So like stick with medical robotics, right?
Mm-hmm.
You know, maybe tariffs on the pharmaceutical sector and the medical sector, you know, maybe the cost of manufacturing in China and then like the bits coming to the UK, so into the US, sorry. And the crazy cost of healthcare in the US and the fact that maybe hospitals, there's lots of reasons why you could be scared and the stock price could be depressed.
Yeah.
But if you look at what the company's fundamentally doing and the results it's getting, the world is going to need more of that in 10 years' time. So just like buckle in and enjoy the ride and just focus on what the company is doing. And that's been my mainstay through 2008, through 2020. You know, when the world goes to crap, just focus on the fundamentals. And that's helped me stick the course.
But if we're talking then about early retirement based on this type of strategy, and you have an event like 2008, how do you handle that volatility?
Let me give you a quick anecdote because I semi-retired because I still got the podcast. Like I'm busier than I've ever been. But I've officially retired from a 25-year career with HSBC, like one of the world's biggest banks. I was never a investing guy. I was behind the scenes in IT and then in like change management, but I worked in that world, and I pulled the trigger and quit in December 2021 because in 2020. I positioned my portfolio, I don't know, combination of luck and judgment, and I positioned it really well for COVID, and I had like a 90% return that year. So suddenly I was like, wow, like I'm feeling pretty comfortable. I retired, and then literally 1 month later, we went into 2022, and the ass fell out of growth stocks. And over that next 6 months, I took something like a 37% drawdown. And it was like June or July 2022. And I was like, holy crap, I've made a really big mistake here. Like, what have I done?
I can imagine.
So that was a test. But I just fell back on my process and my thought that I've seen this before. I know these companies are going to come back. It might take 2, 3, 4, 5 years, but just stick to your process, stick the course, and focus on the fundamentals.
And did your portfolio have that buffer to allow you to not want to go back? Because I'd be honest with you, if that happened to me, I'd be ringing up my boss and saying, "Hey, take me back. I need to come back." Were you tempted to go back at all during that time, or was it just no? I'm going to wait this out and see where it goes.
I was not. Like I discovered, like I've been a skier and a snowboarder for longer than I can remember, and I did my first season in 2020, and I'm like I want to do 3 months of this. I want to be in the mountains 3 months every year. And that's just not compatible with having a full-time job. I took like a year off in 2020 and that was like a taste of retirement. And that taste was too delicious. I didn't want to go back. But I had made a mistake. Like in 2021 into 2022, I didn't have enough cash. And so, you know, that was like squeaky bum territory where I started to worry, maybe I can't pay the bills. Now, like the world is volatile, I am a bit concerned, so I just have a much bigger cash allocation. And if everything goes to crap, like I've got enough cash in my investment account to like carry me through the next half decade at least without sweating too much.
Oh. So that's kind of your so-called emergency fund there.
It's a bit more than that. Like I don't know if cash is, I think it's a fundamental part of my own investment strategy as a professional investor / retiree. So I mean, let's just talk about it a little bit. And Christoph, like, dive in and tell me off if you think if I'm talking nonsense. But like, I keep between. So at the absolute peak of terror, I've had as much as 26% cash in my investment portfolio. And when I say cash, it's like a combination of cash and fixed income. So like a large part of that is in like gilts, like essentially like the UK version of treasury bonds.
Yep.
But I've got like sort of day-to-day money, like a year's worth of spending money in actual cash. And then when markets like we're at peak pessimism and when market like everyone's scared, valuations are depressed, I've had as low as 5% cash. So like the cash pays the bills. That's how I withdraw money every month to literally pay my credit card bill and pay the mortgage. But the cash also gives me flexibility because I'm no longer adding new money to my investment portfolio every month. I'm now a net withdrawer. So if I have like no cash, if I want to buy a new stock, it means I'd have to sell a stock. So that cash gives me a buffer, gives me the agility to buy stuff without having to sell first. And it also gives me we preach on Wall Street wildlife, like you can't time the market. But of course, like an idiot, I think I can time the market. So that cash gives me the ability to, kind of position appropriately based on macro and valuations as a whole.
And what about, I don't know if you're married, but do you have a wife? And isn't her income salary potentially also not an emergency fund?
She probably wouldn't like to hear it described in that way. My wife is still she's got the choice to quit if she wants to, but she doesn't want to just yet. She's enjoying what she's doing. And like one benefit I do get from her is like private healthcare and stuff like that. But yeah.
Yeah, I have the same situation at home. I'm like 2-3 years, I think, from financial independence with my dividend growth strategy, and I don't see that my wife will quit working soon. And we always say, Derek and I as well, it's hard for us to imagine to do nothing. But I don't know yet how that looks like. Probably more of the podcast. But what does that look for you now? Like, so you don't work at a bank anymore. I guess it was also sometimes long days and everything, specifically if you're in IT and you have all these new programs, decommissioning, all of that. How's life now today?
It's pretty chill. I mean, to be honest, like you guys have a podcast. There's a lot of hidden work in running a podcast. Like I could spend at least, 2 days a week doing stuff behind the scenes and research for episodes and like trying to scale our YouTube channel because frankly, we're struggling on YouTube. I guess we're just not pretty enough. But like I've got a bunch of passion projects.
I said, you're not pretty enough. I'm fine.
I got a theory about that. Christoph's hat, I think algorithms prioritize hats. And for some reason, like his YouTube shorts do way better than mine.
That's the hat.
Like, I think there is something interesting here about being an investor. And like I'm working when I'm listening to an earnings call or when I'm listening to a podcast interview with the CEO of a company I'm invested in, or I'm listening to like other podcasters, and I can do that anywhere. So like I try and run every day. When I'm skiing, I'm out for like 8-9 hour days. I've always got a podcast rattling away. If I'm on like a motorbike tour with buddies, I've usually either got music or I've got like some earnings call droning. Everyone's like, hey, look at the beautiful scenery. And I'm like, wait a minute. I'm just hearing from like Jensen. So I feel like I can kind of work and mix that with my lifestyle really, really well. And I feel like I'm being productive and I'm doing the stuff that I really enjoy doing. So like life is now flexible and I can follow my passions.
Yeah. Awesome. And you, Christoph, you're also on this path, right? Towards early retirement. How do you envision it to be for you?
Well, it's kind of weird. I haven't openly said this before, but I think I'm also weirdly sort of semi-retired already too. And that's, I'm going to play with that phrase, but I professionally, I teach at the University of Texas. So, but I have a professor's life. And for the last 5 years, I teach Tuesdays, Thursdays. So basically, I mean, there's a lot of work that goes in,
of course,
to teaching. Technically, I'm working 2 days a week. And then the rest of the time, I have no boss telling me where I need to be and when. And so the rest of my hours go into, like Luke was saying, podcast prep. And I also have a side gig. I write a philosophy Substack, Fire Philosophy, in which I co-write it with a retired professor of religion. So it's about this question, how to live a deeper life. So most of my days are spent reading writing and prepping, either for my teaching duties or for the podcast or for the philosophy Substack. So that kind of means I'm in charge of my time most of the time. And from a philosophical perspective, I talk about this all the time. People mistake uh, money as the most valuable thing. You think investing is about getting more money. I think that's false. It's about getting more time,
Yes.
being in charge of your time. And the money itself, it doesn't actually, there is no absolute number that as long as you're living the life where you're in control of your time, I say you are filthy rich. And I say you are, quote unquote, sort of semi-retired.
Yeah, that resonates a lot with me. And even now, while being on a journey, there's so much, how do you say it, fuck you money in that sense. Like the mental freedom you get knowing that with just a bit of Uber driving, you will get around. That's awesome, because I think it liberates and it allows you to be more objective at the job that you have, because you can more say what you think and do what you say in that regard. And that's been very liberating, to your point, Christoph. But it sounds a bit like you're the Charlie Munger then of investing, because I'm reading his almanac and, oh my God, it's full of philosophers and wisdom. And is this also something like, maybe like the question like that, are Charlie Munger and Warren Buffett also people that inspire you, or are there more other people where you take your inspiration from, also from, let's say, the investing class or just general about life?
Yeah, I'll take that question first. I made there was a phase in which I became very technical and sort of like I was reading all of the financial sheets, the balance sheet, the income statement, and you got to do that to some extent. But I became really technical and I felt convinced I was right because the numbers. And then the market said otherwise. And so early on, I learned it's like, wait a second. So you could be as precise and technically right and mathematically sound and still be wrong. So, and that's not where my heart is. My heart is on the philosophy side. So I kind of made a hard pivot into more of it's not narrative, it's not just narrative stuff, but it felt like seeing clearly and being able to identify your own blind spots and cognitive biases, which are certainly more of a philosophical task. That became what I studied. So all my errors, most of my errors, I'll now today identify as errors of psychology or errors of greed or errors of something that could be corrected through what you're saying, like a Charlie Munger kind of like almanac-y kind of understanding.
Yeah.
So then it's probably go ahead.
And Christoph and I we talked about this a little bit 2 or 3 episodes ago. There's the dean of valuation, a guy called Aswath Damodaran.
Of course,
so he's not that he's a famous investor, but he's a famous academic in the field of investing. And I think part of his framework, he had a really nice comparison that like sometimes an investment is a numbers story and sometimes it's just like a narrative story. And he breaks that down even further, because he says, if it's narrative, he's got something he calls 3 Ps. If you're investing, like Christoph has, well, we both have, but he has more than I do, like pre-revenue companies in his investment portfolio. So there's no numbers to look at. It's all just stuff people have made up, right? So, you could pretend you're doing financial analysis, but you're not. All you're doing is you're investing on a story. And in my view, that is part of a balanced, diversified investment portfolio, but size it appropriately. Christoph's this crazy guy who has 30-40% allocations to some of these companies. That would definitely keep me awake at night. But if something is like a story stock, Aswath says, is this story possible? Is it plausible? And is it probable? So you can start to funnel in and really challenge yourself around, does this story actually make sense? We're both poker players, and it's sometimes it's right to chase for a card that you're probably not going to you're not going to hit this card and you're probably going to lose the hand, but it's correct to make that call or make that particular bet, because if you do get the payout, like it's going to, the return is greater than the risk. And so you can apply that framework to investing too. Like I'm invested in stuff where I think probably more than 90% chance of failure, but if these companies succeed, like the story is probable. And if these companies succeed, then like I've got much more than a 10 times payout. And like that's worked through my investing career. I've got a 250 bagger in my investment portfolio. Like that's, you know, you might only have one or two of those in a lifetime, but when you when you hit them, like that pays for a lot of mistakes and a lot of failed stories.
Yeah. You spoke about, I think it's a good bridge into the 10 principles that you spoke about earlier. Maybe you could elaborate a little bit on those and what you look for when selecting your type of companies.
Yeah, we call them on Wall Street Wildlife our laws of the jungle. And they're just sort of foundational investing principles, like have a resilient portfolio, focus on the long game. Maybe one that is interesting is, I forget the actual term we used for it, Christoph, but it was like investing with friends. I've always had like an investing buddy. I've got several now. I've got like an investing WhatsApp where I try and, you know, help friends come on this journey. But it's good to have someone else who's ideally got like a different view to you and can challenge your own ideas about the stock, pitch the bear case, like try and rip apart your own bull case, because that's how you learn. And if you have friends who can give you constructive criticism on either the way you're managing your own portfolio or a particular stock or a particular trade you're about to make, you're maybe about to buy something or even sell something, like they can give you critical friend feedback on that. You know, maybe you're not doing the right thing.
And Badger, if I can, sorry, Badger, it's natural for me.
Go for it.
Let me philosophize here for a little bit. The principle here that we share is thinking you're smarter than the pack is dangerous. Now, on one hand, it's a little bit contradictory because I think most of the alpha that you could get is when you can spot something that the rest of the market has not yet. So let's bracket that aside. But the philosophical bit is that this comes from Socrates and the Socratic method, which most people don't understand what's actually happening there. Socrates figured out that somebody cannot have a belief and acknowledge that that belief is wrong at the same time. It's a paradox. It's literally impossible, because the way to have a belief is to acknowledge that belief is true. If you don't think it's true, then you don't have the belief, so you can't measure it. So you literally need somebody else to tell you something, you know, to make a statement which you could then either accept or deny or refute and persuade or be persuaded by. This is, to emphasize this, you cannot do this by yourself. So that is the Socratic method. It's a team. It's a process done together. And I think what Luke and I have done is we sort of help one another do this for ourselves. But then when you create a community, that slowly lets in people who act in good faith and are not trolls and are there to contribute and are there to learn and point some things out. It just kind of, that effect kind of grows, and it's amazing what you could do together.
It resonates a lot with me. I think Derek and I often say to each other that we feel like we became better investors because we start to make less and less mistakes, but it is because of all the inputs we get, the challenges. I think it's you, Luke. You own some Gregs as well, which is a very interesting case at this moment in time, right? The hot weather being blamed for the sales, and like anyone ever would have thought that sausage rolls would be, let's say, weather reliant. Yeah. So, and you need an outside view here, really, because if you look at the past numbers, everything actually looks like growth story. So, full disclosure, I also own Gregs, and I think it will get back. But I'm not living in the UK, so I had to do some stock safari, as we call it, when I was in England to check it out. And typically those stocks that are beaten down, right, get a lot of these challenges. And how do you deal with that? Then do you help each other there? Do you coach each other? Do you challenge each other? And I think Rex is an interesting one. I think you both have been talking about it as well.
We have. Christoph's been like ripping into me. Like Greg's is actually quite an unusual company for me to have in my investment portfolio because
unwanted roommate, to some extent.
Like I'm not a fan of the food personally, although I've eaten a bunch of it as part of my due diligence. But I do want to pivot my portfolio more to income because I've got so many people telling me I'm insane being like essentially 80% growth stocks today. And so right now my investment portfolio is probably 2.5% income stocks, and Greg's is like a tiny part of that. I am trying to find companies that I feel sit on the intersection of growth and income. And so, as you say, like Greg's is a bit of a beaten down story. It's quite hard to find, like most of the stuff in my portfolio are like whizzy, technology, sciencey, like Star Trek-y kind of companies. Because frankly, I'm just a bit of a geek and that stuff just turns me on. And so like sausage rolls doesn't really fit that paradigm. I don't think they're making the world a better place through technology and innovation, which is kind of my like tagline on X. But it is a bit of a growth story. And as you said, European DGI, like they are quite beaten down right now. The hot weather is pretty transient. And I do think they've got like a rock solid business model and they pay like a modest dividend. So hopefully, well, I'm glad to hear that is in your portfolio because clearly that fits your guys' view of a great income investment. So that's like a strong endorsement.
So maybe to help you there, because I think, I don't know if you have that as well, we'll ask you later about it. But for us, we're not dividend investors. We're dividend growth investors. We focus on growth first. If the company can't grow, then forget about the dividend. Which means that I end up actually with a lot of tech stocks as well. Microsoft is my number one position. Now, if we talk about growth here and the whole revolution, it started with Satya Nadella with cloud, and then now AI and the deal with OpenAI. I mean, for me, Satya Nadella deserves a statue, somewhere in Silicon Valley or wherever they are, Palo Alto. And so I think if you go to dividend growth investors' portfolios, you will see a lot of Visa, these kinds of things. Specifically, the younger generation will aim for lower yield, higher growth. But even so, I bought Microsoft at $40. I bought Apple pre-split around $100 or something like that. And then Buffett came in and it changed the sentiment around, and we saw multiple expansion and everything. So all I want to say is, like, I think there's a lot of intersection there, but somehow people label a strategy, and you see often then that there is a lot of lack of understanding or wanting to understand about the other one's strategy, and therefore you get this kind of feeling like you need to choose either one. But I don't think that's how it goes in reality with most investors.
Yeah, I think that's fair. But although, like growth is like this huge scale, right? So you've got like literally like subscale pre-revenue. In some cases, almost like I do a little bit of venture capital investing, like some companies like almost pre-business model investing, right?
Yeah.
You can legitimately invest at that end of the market. And then you've got companies like Microsoft and Apple who are mature mega cap behemoths. Still like an Nvidia, like $4 trillion market cap, still arguably a growth investment.
And pays a dividend.
Yeah, it does. It's like it's pretty immaterial, but it does technically. I guess it ticks that box. Yeah.
So if you're looking for income,
but I do like if you're trying to overlay income and growth, I do think you're locking yourself out of like some very, very interesting investments. Because if a company is truly a growth investment, like any free cash flow it has, it's plowing back into its own business. It's doing like smart acquisitions. It's maybe expanding into different markets. It's spending a ton on R&D. It's in my like forgive this sentiment, and it's not how I really believe. But if I took a really extreme view here, right? If a company is at the point where it can afford to pay a dividend, it's like run out of better ideas of places to put its money. Yeah. And so you could argue that's no longer a growth investment. It's now something else.
Yeah, and I think Microsoft again is an interesting case there because it's that the cash is just slashing against the walls there.
Mm.
So how they're too big to still compound at such a rate of everything, because they would gobble up the whole industry in the whole world if they would if we would expect that. Yeah, interesting. We'll get to that soon. Still, so maybe then the interesting one, right? Because for us, being retired means we don't want to sell our stocks. Yeah, we want to protect our principal because we feel like we're probably too stupid to time the market, and so we leave it with management to make the decision for us, and that's why we get the cash in return and live off that. So, what kind of principles, or how do you live off your growth portfolio, I guess, and how does that look like in reality?
So, I mean, it is as simple as just carrying a slightly heavier cash allocation. So, like I said, I let my cash get down to about 5% once way back, and that was probably an error. I'll probably never let my cash allocation drop below about 8 to 9% now. And if I stay at that level, like that's enough money to fund my lifestyle for a long time.
Yeah,
And I just draw down, I pay my credit card bill by withdrawing like a chunk of cash from my ISA every month. And that's kind of, I pay myself a salary in that way. So I don't need income in the portfolio to be able to sustain a lifestyle. And I still, like, the majority of my cash allocation is actually, it's more like money parked looking for an opportunity to reinvest.
So that is what you're really saying inversely, is that you're taking profits sometimes when you think that the growth story is ending and it doesn't justify it anymore, and then you just sell it and that cash will be on your balance sheet, let's say, until the next opportunity, but you make sure there's this level that protects you from okay.
So
I've learned that.
So how do you decide what to sell?
Well, so if we look at, say, an individual company, and Christoph and I diverge here, I think.
Okay.
I've got a really strong, like a thou shalt not pass now. There's like Gandalf on the bridge. If any one of my stocks gets to more than a 20% allocation, and I won't buy something to 20%, but if it just grows to beyond 20%, I will sell it. I will trim it. I very rarely, like, in fact, I never totally exit a position, even if it's extreme valuation, if I believe in the thesis and the story and I think it makes sense. But if the numbers are just crazy, like a company, I'm not a massive fan of them, but a company like Palantir, like egregious valuation, you cannot make an argument for this company as a growth investment because like the next 50 years of growth are already baked into the valuation. But like what goes up can still go higher, and correspondingly, what goes down can still go lower. Like I do think this market is still going to reward companies like that. So I've trimmed Palantir. I've kept it to like a 2 to 3% allocation in my investment portfolio. And every one of those trims objectively has been a mistake. Looking back, it's easy in the rearview mirror because the company just continued to go up. But I still want, like, I'm not willing to just step away from that entirely. I still want some skin in the game. It's only when I feel the investment is broken, like the company has made a material misstep or its objectives just no longer make sense in the world. Like that's the only reason when I'll really fully sell something.
And how about you, Christoph? Do you follow the same type of methodology?
I have made so many mistakes over the 30 years I've been doing this. And the one that has cost me more than any other is selling. Because I've owned all of the great companies early and I've sold them too early. So I would be Scrooge McDuck swimming in gold coins had I not done that. So I'm trying to reform, learn finally, and basically say, because I've done this so many times and I know how to identify these great companies despite the volatility, I'm now in the no sell mode, so to speak. So the way I'm thinking about my own portfolio is price is not telling me much anymore. The only thing that's going to guide my decision whether to sell or not is my perspective on the future. What will this company do in the future? If it's, hard to see, or if I have to, if I no longer really believe in it, I will sell. If the future is like really wide open and like everything is in its favor, I will not sell, and I'm not going to be guided by what I would call arbitrary numbers or arbitrary number of stocks I need to have, or any other kind of thing that I would call is arbitrary. Diversification and that kind of stuff. But that's because I have another principle that I use, which is that none of the money that I have invested do I really fundamentally need to survive.
Okay.
So I paid off my mortgage. And to go back to this earlier point, I'm lucky to live with my wife inside our house. So the house that I paid off my mortgage on is a kind of passive income, vehicle. So were all my stocks to go to zero, I'd still be fine. I could still survive, and so all my investment decisions, therefore, don't have that kind of pressure or that panic built in, because even if they all go to zero, I'd still be fine. This gives me the ability to weather more of these volatile storms and avoid taking arbitrary decisions.
And don't you, that's the first thing that came to my mind when I heard you talking, is because you mentioned the worry about the debt pile. I always think like the stock market is very expensive. It would be quite ironically if now the whole thing goes to shite, like literally, and while you just are in the mode of let your winners run, right? Do you have such concerns with changing a strategy? Because effectively you start to go off pattern from what you used to do.
Is that to me?
Yeah, it's a question to you.
Yeah. I mean, I'll answer this with a case study, because it's the one that's most interesting to me now. And poor Badger is bored out of his mind hearing me talk about it, because I became obsessed with one particular company that I've done more due diligence on than anything ever before. So I kind of know it inside and out and like up and down. And it's a battery storage company, and EOS is the ticker, EOSE. And as I've been following the story, like it occurred to me that I don't really care not that I don't care, but even if the debt stuff blows up, for EOS not to succeed, for all of these tailwinds to go away, everything else would have to go away. AI would have to stop. All of a sudden, the world would need less energy. Like basically everything would have to break for that story to no longer make sense. So, and if I think, okay, well, if that happens, then we're living in doomsday situations, and we're out, The Last of Us zombies walking around. The last thing anybody will care about is their portfolios. So until that's the case, then the debt stuff and all of the bad news stuff goes away, and I just remain confident that all these tailwinds will, despite the volatility, prove out.
I love it.
Yeah, it's quite.
I don't know if that makes sense. Does you have to. I don't want to make it seem simple, because as we know, when bad news hits, everything drops, and then that fear and panic is real. But I also know, based on everything we've said before, that the real companies that make stuff that the world needs will come back even stronger. So as long as I don't panic sell, it's going to be fine.
So for our investment philosophy, it's a little bit easier, because the moment the stock markets drop, we start partying because we get more income for the cash that we deploy. And then if it goes even more further, it's to your point. That means like there will be total anarchy in the streets, and then we have other things to worry, and that's just pure survival and having food. So, yeah. So to that extent, I agree with you, and that's also why macro, personally for me, then, and I think it's for you as well, Derek, doesn't really matter to us. Some companies that are just very sensitive to it. Is the question, do you even want to own them? Yeah, and we call them typically then cyclicality or something like that. And for me, there's only a very small place in my portfolio for cyclical stocks, because anyway, they typically put already a dividend at risk. Pretty much like banks as well, because they're heavily regulated in Europe. So and we saw that during COVID, that insurance companies did quite well still, but mostly the banks or French companies, they get regulated and they are not allowed to pay a dividend or kept to pay a dividend. So that's the nice thing about investing. If you have a certain strategy like that, 95% of the stock universe filters itself out already in that case.
So maybe we have some listeners' questions, but maybe before we go to that, we'll ask one final question, okay? And I want you to be brutally honest. What are your thoughts on dividend growth investing from your perspective?
I'm trying to adopt it now, and I'm sort of dragging myself kicking and screaming. And it's, so like Greg's, like I said, that's way outside my wheelhouse normally.
Yeah.
I've got one or two companies that pay a bit of a dividend, like BYD, the Chinese auto manufacturer, Alphabet. Like I've pays a small percentage dividend, but I've got a pretty massive allocation to Alphabet. So there's like some dividend income there. I'd like to get my actual income investments up to sort of closer to 10%, which means like I need to quadruple that. And I make changes like this in my portfolio very slowly by design. I just make nudges rather than big changes. So my plan is to get there over the next 2 to 3 years, I think.
Okay.
I think I'm more in the middle here. If it's just dividend investing, I say it's boring as fuck, and I would not do it.
Okay, I need to challenge you there because it's very exciting to check whether there's 80 milliliter beans in a can or 90 milliliters bean in a can. Yeah.
So, that's my brutally honest answer, because the way I think of pure dividend investing is like the stage at which that company is known. It's so calculated precisely. It's not much is going to change. So I invest in part because I want to learn about the world and I want to learn where the world is going and follow all the, tech advances and yada, yada. Right. So it's kind of like an adventure. But when you guys frame it as you do both, you try to find the sweet spot that is dividend and growth, because the companies are gushing so much cash, they don't know what else to do with it. I like that. That's like something I'd be open to learning more about, as long as that sweet spot is really there. And it turns out, when I was doing research for our show today, it occurs to me I have in my own portfolio and in the portfolio that Luke and I lead on Wall Street Wildlife, a company that I think is exactly perfect for what you guys do. But I didn't pick it from the perspective of the dividend. It just so happens to have a dividend.
Yeah. And which one is that?
Nintendo.
Oh, Nintendo.
Nintendo. Yes, it's a fan favorite, I would say.
Okay.
Yeah, cool. Because it is also like sentiment back to the 90s for many. And yeah, there's a good dividend behind it. Yeah.
There's a... go ahead. Yeah, there's a 1% dividend, but I didn't. Yeah, I did a deep dive into it because of the future growth, and like I think of it as there's a moment in the early 2000s, I think, when Disney and acquired Pixar and then Marvel Comics, and then they became this kind of transformed themselves into this. The sum of the parts was much less than the total. And I kind of see Nintendo doing the same exact thing in this moment with the Apple ecosystem. Yeah. But then the theme parks and then the movies, and most people are sleeping on it. But I was like, wait, this is like an inflection point for this company. And this is an ancient company. Yeah. And they pay a dividend? Cool. Yeah. Like that's... Yeah.
I think... what I can only say about like learning about the world, I think it applies to dividend growth investing as well, because the moment you open up an annual report and you read the first 2 pages of the shareholder letter, you learn a lot about the world. I guess you may be more in the riskier stuff, let's say the early innovation. On the other end, if you look at the big tech company, I say Microsoft again, for instance, they're doing a business with AI and OpenAI, and they think, who's OpenAI? Iberdrola, it sounds the most boring energy company probably from Spain. They do wind energy and hydrogen. but you need to learn about hydrogen. You need to learn what that means, and then you start to open up a whole world of new technology in a certain industry. But I think people call it more low tech than high tech. So I think that's I think generally the beauty of investing. The moment you start reading annual reports, listening to earnings calls, you just become much more aware of what's going on in the world, whether it's the Ukraine war that has an impact on a business, or whether it's new innovation, quantum computing within pharma, and everything, where they're trying to really discover new cures to diseases due to the ability that quantum computing and AI, for instance, offer. But it's I totally agree with you. It's not in the subtle innovation that you see, where you have the founder, the entrepreneur with an ID. Here it's typically corporate managers with IDs, and those are often not the right ones to work on those IDs. Interesting.
Awesome. So we might jump into some listeners' questions. There's about 4 or 5 of them, if that's okay with you guys. And the first one comes from Centrino. And he's asked if you can mix your strategy with a dividend growth strategy. And if yes, what 5 growth stocks would you put in a mixed portfolio?
I don't know that I've got 5, if I'm honest. I've just added Greg's.
Okay.
I recently bought Novo Nordisk.
Yep.
Again, a little bit of a sort of beaten down story. They've got some, I'm not a biotech guy. That's definitely much more Christoph's wheelhouse, but I understand they've got some interesting drugs in the pipeline that might make them competitive. Like, there is a growth story there, and it pays a handsome dividend. So that would be in my list. Maybe some of them, like defense stocks, L3 Harris, Lockheed, companies like that.
Yep.
I've got a small application to Lockheed, but yeah, I've started listening to you guys, and I'm trying to find a few ideas in this space now.
Is Google, does Google pay a dividend?
It does.
Yes, it's a future dividend aristocrat. They just still need 24 years. Yeah.
Edgy, I like your perspective, like everything you said about a company like Microsoft, that gushing cash, or I think, as you said, when they just have so much of it, they don't know what else to do with it. I'm all in. I would totally be satisfied with adding a company like that. It's just that right now, in this particular moment, I have such high confidence in my pre-dividend companies that I don't want to diversify away from them.
Exactly. Yeah. And Google is a very interesting case at the moment, because I believe, Badger, you worked in IT, and I see my search go down on my blog. And it is not because of the SEO ranking or anything. It's because questions are already being answered elsewhere. So I really wonder about their ad revenue business, while at the same time, they're pulling off one of the biggest catch-up stories in both cloud and AI. So it's really like confusing the hell out of me. Like, on one side, with Gemini, they're hitting it well, and then the cloud business is on fire. But it's so small that I wonder, can it compensate in the very, let's say, in the next 5 years for the potential like bloodbath in their ads business there. So for me, it's like, I understand why it's beaten down, because it's so hard, in my opinion, now to make up your mind on Google as that. And then I think to the point that you made, Luke, it becomes then about the story more for Google than the actual facts here. But I wonder how you look at that, at a company as Google right now, with this threat to the let's say the legacy business, and then the innovation in the future.
I went into bat for this quite recently on social media, and I wrote a pretty long post, and it took me like 20 minutes to really get down the rabbit hole. But the essence is, like, I ban Apple. This is sort of personal disclaimer. I ban Apple products from my house. Like, everything is Android. Every room's got like a Google speaker in it. All the phones. My wife, I forced her to get off her iPhone. Like, all of our phones are like Android Pixel phones. They've been that for decades. So I feel like I know this ecosystem as an end user well. And if you just sort of stand back from, are they really losing the AI race? They're not, right? They've got, I think, 2 billion user products now. And it's Android is the dominant handset, something like 70+% of handsets in the world. They have more data than any other company on the planet. And, Meta build their story around understanding you. Alphabet know you much better than Meta do. And they've also got like DeepMind, who are arguably like the world's greatest like research institute for AI. Like these guys have got like more Nobel Prizes than most other companies have got like academics. So you put these things together, like their massive distribution of Android and their ability to like deploy their AI behind the scenes and start serving up. Well, I mean, let's just sort of talk briefly about like the future of advertising. Like today, people think about Google advertising as being like the 10 links when you search for something, sponsored things. And, you think you're smart and you try and avoid that sponsor stuff and you try and click on like the real thing you want. Well, the future of advertising is Google knowing you so intimately. And when you ask its AI something, like the ad is built into the answer, but it's like value add. I gave an example in this Twitter thread, right? If Google knows because of all the other behaviors I exhibit that I'm like a health conscious guy, because it's seen that in my emails and my interactions and the stuff in my calendar and like how many steps I do a day and my exercise and like the stuff I'm Googling around nutrition. If it knows that, like if I say, give me an example, like, hey, recommend like a pizza restaurant nearby, well, it can give me like a value add response because it knows I'm a health guy and it can say, well, actually, here's this pizza restaurant, which is like an extra 2 or 3 minutes walk, but we know you like your steps. And they have like these health conscious options. And at the same time, like through the magic of like the way ad tech works, like that restaurant has purchased that high intent result. And so they're selling that advert in real time to that restaurant at a much higher CPM, like the value of the ad, than it would have been if I just like naked did a search for that same thing. Because like Alphabet is much more confident that I'm actually going to follow that recommendation. So kind of trivial example, but you take that times like a trillion searches that are done. And that is the future of advertising. Like our conversation with Gemini or with Google's like 2 billion user products will have these AI results built into it. And that's going to massively increase the Google's like advertising revenue potential. Just the market can't
because
seem
they
to see
can
that.
charge the advertiser more because of the click through, let's say, or the buy after the.
Exactly.
It's for me, it's very interesting, right? Because I studied in the past two-sided platforms and the network effect, which we're talking about here, effectively, and then what it takes for companies to lose that. And it's always been technological disruption. And I think for the first time, they are technologically challenged. So it will be very interesting to see how OpenAI pulls off with its own browser there. But I think Google has a lot of, they have a lot of opportunity, let's say, to keep the users in their platform, let's say, like Microsoft did with the whole Copilot and the ecosystem, right? So and therefore turning their legacy business into a cloud business. I think Google is needing the same transition now there.
Yeah. And you can see that, right?
Very
Because
interesting.
Sergey Brin is suddenly like back in the office and suddenly doing podcasts and suddenly like acting.
Exactly.
He and Larry were like these founders. They built this incredible empire and they essentially like retired off to do their passion projects and left, like a sequence of very, very capable CEOs at the helm.
Yeah.
Well, now Sergey's back at least, even if Larry's not, and he's there like fighting the fight. So that is kind of
really
panic
good.
mode, but this guy's an incredibly smart guy.
And to tie all of these strands together, let me openly confess that I had the same exact question as you, Edgy. Totally like confused, and like I could make an argument either way. Badger talked about this on our Wall Street Wildlife podcast some episodes ago. Really got me thinking. So kind of helped me took me out of that confused spot. I did a bunch more deep research about Google's call it fundamentals, and I changed my tune and Google is very high on my to buy list. And the
Yeah.
only reason I haven't bought it is because I like all my ideas already, and so I just don't have the extra cash for them that I want to siphon away. I would if I was in the, call it, later stage of life or later stage of investing. So kind of Google is such an interesting test case for, I think, everything we've been talking about.
And the fact that you both can articulate on that is also a reason why our listeners should definitely also subscribe to your podcast, because I think it's a little bit scarce in the world of social media to have a little bit of a deeper conversation about things. And we stay even on the shallow level still, but you can sense it from the way you argument that there's a lot of deep knowledge behind it. So definitely recommend to follow you guys.
Yep. Hans de Jong has asked the question. This may be more tailored to you, Luke, because you're trying to allocate a little bit more to income. Could you see an ETF like JGPI, so JP Morgan Options Income ETF? Could you see that as part of your portfolio in the future?
I only own one ETF,
Okay.
and that's to get exposure to the Indian market, because I do think that's an incredible growth story, and you can't easily invest in India unless you're like an Indian national. I glanced at this just like at 6 a.m. this morning, drinking coffee. It looks like a reasonable ETF. Like, it's got some decent holdings, but like, it takes the fun out of it, buying an ETF, right? And like, it doesn't fit my framework. I really like to invest in individual companies and have like agency over my decisions and my allocation. Why would I pay JP Morgan like a fraction of a percent of my returns, but I'm actually giving away like the fun of studying these companies? So it doesn't work for me. But if you want growth in your portfolio and you don't mind paying, what is it, like a 0.3% expense ratio, something like that, then the holdings look okay to me.
I can help you there, Luke, because what you're buying here is a covered call strategy. So if you have fun in selling covered call options as a job, and yeah, then it will take the fun out of it. But I don't fit, for me, there's no fun in it to buy companies and then only doing covered call options. So that's what this is. But what it does to people, it gives them like a 10% yield. So it's really current income, but your upside is kept. So the net asset value there, don't expect a lot of growth at all, because it's just capped by the covered call strategy.
Right, there we go. So you've betrayed my ignorance around this particular index, and this part of the market is just not the place I look.
It became very popular in the dividend, I say on purpose, dividend community here, because it gives them current yield. And people think about like, okay, if I'll take a 10% yield now, I boost my income and I can reinvest that. So that's kind of the thinking behind it. I think Derek and I are both not a fan of that, because we just want to see our income grow over time, and that's more of a preference for us.
Thomas has asked us a question about getting close to retirement and if you should shift towards more high-yielding stocks, dividend stocks, and if you do that, how would you sleep well at night?
Well, my own sleep well at night is having like an allocation that's broadly aligned with my conviction, and then like this, thou shalt not have more than 20% in a company, no matter how much you believe in it. So like a good test, and Christoph and I talk about this quite a lot, because a large part of the discipline of being an investor is managing your own emotions. That's almost in some ways more important than the actual stocks you pick, because if you don't manage your emotions, fear or greed or FOMO, like these things will make you take dumb decisions. So I sleep pretty well at night. Do you need to transition to income as you get sort of later? And I understand the basis of Thomas's question. Like, you don't have the time if you're old for the growth story to play out. I don't think that's true, because growth stocks are forward looking, and like these stocks are valued based on what the market thinks they're going to do. So if the story changes in some nuanced way, and we had then, maybe in 5 years' time, the company has hinted it's going to do something, well, that'll suddenly be baked into the price today. So you're going to get either the benefit or the consequence of that right now. You don't have to actually wait those 5 years for the story to actually unfold.
Awesome. And it probably leads into Tim's question, how he asked, how do you sleep well at night on growth stocks? So maybe Christoph, you might take this one.
Sure. One, don't commit any of the fundamental errors, which are easy to commit if you are not working with a team or a community, and you become a lone wolf. It's very easy to persuade yourself that something is the case when it is not. So one, just make sure the basics are there. Like, do not use margin ever under any circumstances, for example.
Yep.
So then, but then I learned to have confidence in the research I've done that is legit. Like, so I've learned to basically put price and price movements in one side and everything I know and have confidence on the other. And I acknowledge ahead of time the price is going to be zany. So that's just not going to scare me unless something fundamental goes wrong. But I think something fundamental can go wrong in any company, no matter how solid, or, like an accounting fraud issue, or, Johnson & Johnson does, some whatever, any
3M is a good example. 3M with the PFAS.
3M, or so it's almost like that distinction between growth and dividend is sort of arbitrary from one way of looking at it. So I sleep well at night by earning the confidence in the stocks I buy, and not making any of those other mistakes.
Yeah, makes sense. You've kind of answered this question in part from Hugo about selling stocks, but does market momentum take part of that decision when you're selling?
Christoph uses technicals as part of his framework, and I tend to scorn that and say it's like magic and it's like casting the runes. But there is something in that, I think. And on our podcast, like, I would never say this on Wall Street Wildlife, but there is something certainly at a kind of macro level, and understanding like the trajectory of the market and the emotions of the market. There might be something in looking at like moving averages and all this other magical stuff.
Yeah.
So I'm only saying that here, right? I'm not going to say that on Wall Street Wildlife.
You'll never do that on our show.
Do you want us to block that out? We can edit that out if you want.
I think you can, like, not technicals, but you should be looking at, like, I got a case in point, right? So I said at the top of the podcast, Intuitive Surgical has always been like my biggest position. Well, in the last 2 weeks, my biggest position is now a company called Rocket Lab. Incredible growth story, and it's like a 10x in my portfolio in like 2 years. And I'm actually quite allied to this company because I buy like an investment Christmas present for like all my friends' kids every Christmas, and I bought them all Rocket Lab. So I'm feeling like a genius right now because they're all like, "Woo! Like, our present's looking really good, Uncle Luke." So I really want this company to succeed, but at the same time, like, momentum, it's got well ahead of its actual financials. Like, Wall Street Bets has got a hold of it, and it's just being like, it's literally going to the moon because it's like a space company. And if you look at the numbers, like, the story of this company is their space systems segment. Like, they actually build satellites, and they have like an end-to-end space company, and they try and put these things into orbit and they operate them for you. But the company's being valued based on, like, it's transitioning to Neutron, like its new medium lift platform, which is much more competitive with SpaceX. And it's now, like, if you tried to invest just on the financials, which I did in the past when it was like a $3 or $4 stock, that no longer makes sense. Now it's a $50 stock. So I'm going to start trimming that soon because it is a momentum story, but I want to let this story play out just a little bit longer before I go back into trimming mode with this one.
And if I could, here, I'll simplify the technical stuff.
Okay, go.
Badger, open your ears. You still might learn something, huh? Forget all the fancy, charts and, like the astrology version of technicals. You know what I'm talking about? The patterns, people seeing patterns. Like, okay, get rid of all of that. All you need to do when you open up a technical chart is see if, let's say, you use the monthly chart, and that just means the candles you see on that chart represent a month of time. So you could see like the big picture, right?
Yep.
In one nice chart. If it's going up, you can buy it. If it's going down, do not buy it. Right? That is like one of the best ways to use a technical chart. Now, an exception. I broke that rule for a very good reason with one of my largest holdings now, Relay Therapeutics. Why? When I look at the chart's going down. Like it's a bad, nasty, ugly chart, straight down, which would suggest, no, don't buy it. But when I look at the data is getting stronger and stronger and better. It's a biotech. Biotech is out of favor right now. Biotech, I know, can jump, it's a matter of like yes and no. It could jump 200% overnight. So that's a case where despite the technicals, as long as the fundamentals are getting better, the alpha is growing and growing and growing. So I'm continuing to add and add and add. So I'm sort of breaking my own rule, but I know why I'm doing it.
Okay. Yeah, interesting. Every rule has exceptions, I would say. But it probably leads then to Georgie's question. Do you dollar cost average into positions, or do you wait for corrections to buy your growth investments?
I DCA in.
Okay.
I'll take an initial position based on not a huge amount of due diligence, and for me, initial position is like 0.5% to 1% allocation, and then I'll listen to a couple of earnings calls. So naturally, I'm going to let like time play out, typically 6 months at least. And if I kind of feel like I'm understanding the story better and it makes sense to me, I'll then start to add. And I've got companies I've added to 4, 5, 6 times, and don't be afraid to add to your winners. Like I think that's a really foundational part of a strong in growth investing strategy. Like it's the temptation, your emotions will tell you the stock's going up, so start selling it, take some money off the table, play with house money. Like these are flawed concepts. You want to back companies that are executing successfully because by definition, they're the ones that are succeeding. And if you add money to the ones that are failing, well, what goes down can still go lower. So yeah, I will DCA in. My other rule, which I actually broke with Alphabet recently, is I'll never add new money above a 6% allocation. So anything in my portfolio that's more than 6%, like it got there organically. But to me, Alphabet seems like such a strong growth story and so reasonably valued among its cadre of like the Magnificent Seven. I felt like I just had to add more cash to that, if only just to say to myself, like, you really believe in this one for the long term.
Over on our Patreon, so we have what's our address? Patreon.com/Wall Street Wildlife. We have the way we set up our podcast in order to bring people in, to bring investors in, we set up a portfolio challenge. It's the King of the Jungle portfolio challenge, where each month in the first year, we started with $1,000 because we thought that's a reasonable amount of money that anybody probably has access to. And then we added $100 the first of the month. Now it's $200 at the first of the month. But we say openly, if most people could save $100 a month, right? It's not like it's not.
Yeah.
We're not talking. It's not about the huge numbers, right? And so the first of the month, we have $200 to play with, and just recently, I said on our Patreon channel, on our trading channel, look, I don't like how frothy the market is. I don't like how it's like Momo stuff, and yet here's a company that I think is undervalued and has this immense future ahead of it. So I don't care. I'm not going to market time. I'm going to buy more shares. And that's dollar cost averaging, basically.
So I need to ask this because you're a philosopher, right? And how does this apply to life? Because I would love to have dollar cost average it into a marriage, but what you do is like you start dating. Dating is like reading the annual reports. Yeah, then you listen to the parents and you meet them. That's like listening to the analyst in the earnings call and your friends, right? And there you are at the altar, and you do the biggest lump sum investment in the world in your entire life. You just put all the cash and all the future cash that you will ever earn into a single investment. How do you look at that as a philosopher? And then knowing that dollar cost averaging is usually a more moderate approach to wealth.
Before you answer that, Christoph, like Edgy, is it very traditional in a Polish wedding for your vows to include the fact that this is sunk cost?
Maybe that's the key, or this is about like who brings the most.
I think I'm going to pull from Kierkegaard on this one. In something like marriage or love, the beauty of it can't be quantified. So it's sort of like, I wouldn't say necessarily transcendent, but it's not, the sum is greater than the whole. Let's say it that. But in order for something like faith to exist or God to exist, it has to, by definition, be unjustifiable. You have to be able to leap into it blindly. Otherwise, it's just science. And if it's just science, it's not love or marriage. So at some point, because we're limited beings, we can't know everything. By definition, that's the difference between God and us, is we don't know everything. That's what makes time. Then I would say I would flip it around. It's like, because we have to leap, because there's danger, because we don't know, because it's so scary to do, that's what makes it so beautiful. And we have no choice. You have to act. And if you ever read any Kafka, right, or any Kafka stories, he himself was overact with anxiety, and like his stuff is about how not being able to like make that leap, how like you could end up in your head like just arguing with yourself forever, like that paralyzes people. So my answer is like with stuff like you have to act. You'll never have perfect information. Like at the poker table, you could be holding aces, you still know those lose to at least 20% of the time, but you're an idiot and you don't belong at the poker table if you're not playing your aces.
No.
Good answer.
Good. I've got some time to
I've met
think now.
Christoph's wife. She is aces.
Nice. We might move on then to this community portfolio that we have, and we shared this with you guys already. And what we did maybe at the start of the year is we asked all our community to pick the 10 best dividend growth stocks, okay? And then over time, every time we have a guest on, they have the honor of removing one and adding a new company in. So it has changed quite a bit over time, I would say. We've had 5 or 6 people remove companies. So the portfolio is Visa, Microsoft, Johnson & Johnson, Realty Income, Eden Red, Munich RE, Shell, S&P Global, Louis Vuitton, and Automatic Data Processing, okay? Your job is to remove one and add in a new company for us. So go for it.
I've got the ad. I'll let Christoph take the remove.
Oh, that's how, oh, damn it. You sure we can't flip it? So we sort of went with Shell as the one to remove, and I think the high picture there is that the world, despite what some administrations are doing, is moving toward renewable and solar and so forth. So Shell, to some extent, feels like a little bit of a dinosaur. Like, I'm not sure that's where I want the eggs. And yet I have a counter argument because I know even a company like Shell is involved in renewable fuels, for example. Like, they're not dumb. They also have ways to hedge their bets and so forth. So I don't think it's as simple as them being a mere dinosaur, but that's the one that I'd be most worried about. And also doesn't necessarily feel good. Sometimes I use emotions in this way. Like with all the companies in the world that I could own, do I want a company that isn't necessarily aligned with what the world needs in the time of global warming?
And it just occurred to me as you said that, like, it's a
and the
company's
next
business model is built literally on dinosaurs, right? Because that's where they all came from.
and on the wildlife. Yeah. So you're loyal to your own podcast name here. It's my second biggest position, Krzysztof. And maybe in the next podcast, I can explain you why.
Yeah, no, I'd love to hear that. Yeah, exactly.
My ad, you've snapped on it already, Edgy. It's Greg's. I've got very few income investments in my own portfolio. I do think this is quite an interesting, not really a turnaround story, but people don't realize like Greg's is like nearly 100-year-old British brand. It's embedded in our culture. Like I may not eat the food, but there are millions and millions of people who are raving fans of this brand. And if we are going, I think it's interesting right now, because if we are going into like tighter times, maybe a recession, I don't know, I'm not forecasting recession, but like interest or inflation was surprisingly up just a few days ago, right? If the purse strings get tight, then households and individuals do tend to fall back on brands like this. So I think it's probably going to be a bit more resilient in a tough economic climate. And it is a growth investment. Like they are trying to get from 2,500 stores to over 3,000 stores. Yeah. Like there are legitimate arguments. Maybe that's beyond kind of saturation. But there's certainly precedent for that. Like they're at similar scale as companies like Costa, and they're still growing like wildfire. And they do pay
McDonald's
like a healthy dividend. Yeah, exactly. So Greg's is our ad.
Can I Can I add a second, or you keep it only to the one?
We keep it to the one, but if you want to share your thought for a second, then let us know, Krzysztof.
Sure. I mean, I just want to double down again on Nintendo, because here you could either buy sausages or you could have fun.
Or both.
Well, so I think you guys are going to ask us for a stock pick of the week. So go on, why don't you have our stock pick of the week as your Nintendo, Christoph, so you can get it in there.
Yeah, let's take that one, Krzysztof.
Okay, and then what about your stock pick of the week then, Luke?
So it's a company we haven't talked about so far, and I literally just added to it yesterday. I did say to Christoph, because we were thinking about this, and I was like, oh, look, if they ask us for a stock pick, we can't talk about anything too fruity. Like these guys' audience is going to be a little more like risk off. So I think I've got like a nice blend of interesting growth, but actually relatively stable. It's a fintech company, Wise, previously known as TransferWise.
Okay.
Yes, I used it a lot.
I don't know if you guys have heard of it or used it. Like I'm a raving.
I used it a lot.
I use it.
Fantastic. Yeah. Like I found them when I was working for Seven Investing, and I sort of started that as a side gig post HSBC. I was getting paid in US dollars. So I had to get like international banking of some sort. And what an incredible banking product it is. But I think the company is a little bit misunderstood. Like essentially they're like the experts in FX and like international transfers, and they've completely literally reinvented the way international transfers are done. It used to be this thing called the correspondent banking system. Well, it still is. That's a large majority of international transfers. Wise have reinvented it. If you want to understand why, like I did like a whole 30-minute deep dive on this on our YouTube channel. But the reason I think the market misunderstands it a little bit is the investment thesis around Wise is actually something called Wise Platform. Because sure, they've got millions of raving fans who are personal and business customers, but they also kind of white label their services and they plug in to other banks. So they're now partnering with typically smaller regional banks who want to offer these incredibly fast, incredibly low cost FX to their own customers. And now Wise is there holding their hand and making their network available to them so they can give those incredible low cost capabilities to the customers. So they took a bit of a knock overnight when results came out 2 or 3 days ago. And so I just took advantage and added to that one yet again in my own investment portfolio.
Nice. And this is where a dividend investing and growth investing come really together, and the stock market is brutal because look at the price chart also of Western Union over the last years. Effectively, Wise is putting this business out of business. And that's the beauty of why you need to have in your portfolio at least also as a dividend growth investor, let's talk from that point of view, you need to have companies more on the earlier part of the life cycle to balance off the portfolio that are maybe a little bit more on the end of the life cycle, because otherwise your portfolio will be just at the end of a cliff. Yeah, and there's no fresh growth coming in. Yeah, really nice one. I loved Wise as a customer. I use it every monthly. I got paid in a foreign currency. I had to use it, had the lowest FX rate. I remember you needed to send money there. And I'm talking about 12 years ago already. So this company is not new. It's not like invented 2 years ago. It's already quite long around. And it has been always, my bank even didn't like it that I was sending money there, because they charged a 3% FX rate. And I believe Wise 0.5% or not even at that time. And that's their business model.
Yeah.
It's a great product, and like 70% of the customers come through word of mouth. Like, that's a strong endorsement.
Mm-hmm.
Yeah,
exactly.
And actually, it's the second time we've heard this company this week, European DJI.
Yeah, true.
So
true.
It must be one that we have to pay attention to.
They don't unfortunately pay a dividend, so I don't know if it hits your guys' framework.
No, but not yet. But that's maybe also what we see, is that many of our listeners, they have maybe 50 or 60% in dividend growth. Then they have maybe 10 or 20% in high income. But then they have also some Bitcoin or some pure growth. So it is not that. And even myself, I've got like some play money for growth. So that's why I still have Google in my portfolio. I did have Meta going from 170 to 500 when I sold or something like that. So there are these and some they just started to pay a dividend over time. And I think that applies to many investors. I don't think there are many people that are like 100% dividend growth only, and for the rest nothing.
Yeah, awesome. Hey, listen, guys, that's the end of the show. Thanks so much for coming on and joining us. It's been an absolute pleasure having you on. European DJ, I said it already, but our listeners should definitely check out your podcast. It's lots of fun. You do bring the fun element to investing while having the knowledge behind that. So I'm a subscriber, and I hope plenty of our audience are as well. So thank you again for joining us.
Yeah, we'll add all the stuff to our description, your social media handles and everything, so that they can easily find you.
Well, and we've got hopefully an upcoming episode that your listeners will enjoy, because we're hoping you guys will join us on Wall Street Wildlife, and we're going to give you a real grilling about dividend investing.
Awesome.
We look forward to that.
Looking forward to it.
Thank you so much.
Thank you as well, Christoph.
Thank you.
Okay, and to our listeners, we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.